throughout the next hour or so. And then the missing bullet in this page is actually at the end of the presentation. I'll also talk about some updates that we have made in our internal financial guidelines. That's been effective actually since April of 2025. Now, the external version for advisor use is not available yet. It is still in the works for final approval and for marketing and for just to make sure that everything looks good and ready to go. But meanwhile, these new financial guidelines have been effective since April 2025. So I do encourage you to stay till the end of the session and do listen to the updates in financial guidelines because I think it's really important for you and your business. And because this is the last training session, if there's an extra time, I do encourage you to ask any questions, drop them at the chat box, and I'll do my best to answer them today during this session. Let's say if there's some extra time. It could be either financial, medical, or anything about reinsurance that you didn't understand, but you want some clarification. So why we're using reinsurance? Insurers, we utilize reinsurance as a risk management strategy to transfer portfolio of portions of the risk portfolio to other parties, in this case, the reinsurers. So by using the reinsurance, insurers, we can spread out the exposure to large loss and protect our financial stability. We also allows us to take on more policies and larger risk than we could handle on our own. Some of the advantages of using reinsurance, as you can see here, is improve the capital efficiency because it frees up capital that would otherwise be held against any potential large claim. Increase underwriting capacity. So later on, when I talk about capacity, you'll see that if for large cases, face amount exceeding a certain number, we have to seek out multiple reinsurers for capacity needs. And at that time, when I talk about capacity, I'll also talk about multi-apping and some of the advantages and disadvantages of multi-apping. So stay tuned for that. So increase underwriting capacity, enabling insurers to write more business. It also protects against catastrophic losses that could threaten our solvency, and also access to reinsurance expertise and global insights. So with treaties with reinsurers, we get access to their life insurance and CI underwriting manuals. Now, Sun Life, we have our own manual. It is very thorough, but sometimes if we know we can maybe get a potentially better offer from a reinsurance company, we can also look into their manuals and see if it is more aggressive or favorable. And at the same time, reinsurance companies, they regularly organize underwriting training seminars for underwriters to attend. And these seminars could be just on a specific topic, medical topic or financial topic, or even just talk about some current trends in medical advances and underwriting risk philosophies. So these are very interesting. It's good for the underwriter for their continuing education because underwriting evolves with time, just in the same wavelength as medical advances. For example, if we talk about HIV, like now, maybe like 10 years ago, no insurance company would insure anyone with HIV. Now we have insurance companies, including Sun Life, that would open the door to people with HIV. Again, these are case by case basis, and also coronary artery disease. Like with the medical technology we have these days, we know more about the condition, and as such, our risk tolerance is much bigger in terms of when we look into someone who has a CAD case. So in the end, underwriting, it is constantly evolving with time. Sometimes when we look at rated offer, sometimes we can seek reinsurance for support and see if there's a possibility of getting a better offer on impaired risk. So mostly medical or non-medical. Sometimes if it's a case that was postponed by Sun Life, an underwriter will probably send the case to our reinsurers to see if they're willing to to partake in the risk and make an offer. So reinsurance also provides insurers with some of the flexibility in managing their business mix and expanding into new markets and lines of coverage. So earlier I talked about mitigating the risk. When we get to capacity issues, retention issues, issues that exceed our auto bind limits, which I'll talk about in later slides, then we can spread the risk and to multiple reinsurers. So what's reinsurance? It's transferring a portion of the risk from direct insurance company to one or more other insurance companies. In this case, we're talking about the reinsurers in exchange for a portion of the premium paid. So if you look at this diagram, I mean, it's picture. You have a direct relationship between your insured and Sun Life. And then on the other side, Sun Life have relationship with multiple reinsurers. Some of the reinsurers have something called a retrocessionaire, and this is another word for a reinsurer's reinsurer. So even reinsurers themselves have other reinsurance companies, we call them retrocessionaires, that enable them to mitigate the risk to other companies. Now, from an advisor standpoint, or even your client standpoint, what you need to know is all the policy contract is with Sun Life. No matter whether or not we are ceding the risk to reinsurers or we are fully retaining the risk, it is with Sun Life. When it comes to claim time, again, this is Sun Life. We might contact reinsurers to deal with some legalities that matters and in terms of claim amount, but what you need to keep in mind is policy contract is with the direct carrier. So if your contract with Sun Life, it's with Sun Life. Other carriers is with other carriers. What we do with reinsurers is really in the back scene. So retrocessionaire, it's a company again to which a reinsurer transfers all or a portion of their risk for the purpose of reducing their exposure to a loss the reinsurer has assumed from the direct writer. So it's just everyone's trying to mitigate risk in this picture, and then how we do it is we have something called the reinsurance treaty, and the treaty is a legal and binding agreement between the reinsurance company and the insurers for the transfer of risk in exchange for the premiums paid. So with Sun Life, we work with 5 reinsurers in the industry, and then those 5 reinsurers, some of them might have multiple retrocessionaires, and some of them might not even have retrocessionaires. So that depends on the reinsurance itself. But like I said, this is all in the back scene, but just to explain to you what's going on throughout during the risk mitigation process. So I want to introduce you some of the basic reinsurance terminology. So capacity, you might know this one, you probably hear it a lot of times, is the maximum amount available on an insured. So, and we're talking about the maximum, the NAR, so the NAR value and not the face amount. So the Sun Life capacity is actually 300 million. So how we get to 300 million is, well, Sun Life has a certain capacity, and then we would try to get the maximum capacity from our 5 different reinsurers. So in total, we have 300 million on par, 265 million on term, and 285 million for non-par, so permanent or annual. Now, retention. This is the amount that Sun Life can retain on its own without seeking support from reinsurance. So in Sun Life, for a par product, we can retain up to 25 million from ages 21 to 70. And if it's a joint policy, it's 30 million. So what this means is, if it goes beyond our retention, then we have to consider getting capacity from either reinsurance or with something called auto binding, which I will explain in a later slide. But just let you know that, or we can retain up to 25 million, which in a way that's pretty good for a par product. Even for a joint product, it's 30 million. That means that if the NAR does not exceed 25 million, we can retain 100% of the risk. And that means that Sun Life can ultimately make a decision on the case without going to any reinsurance companies. And that can actually save a lot of time for you. Reinsurance companies, they can come back usually with more additional requirements. They might need more medical information, financial information, but with the ability to retain 25 million, we can eliminate the those additional requirements. Seeding. So what seeding means is the amount a company will give to another company. So earlier I talked about retention. Now that's for par, but with term product we also have a retention, but we don't retain 100% of term products at Sun Life. What we do is I use the word a lot, mitigate the risk to reinsurers. So in this case, we seed. We are giving some amount to the company. So seeding could be automatic, or it could be facultatively, which I'll explain afterwards. But just if you know, the word seeding means transferring amount or transferring risk to another company. Retrocession, I talked about earlier, it's basically just a reinsurer for the reinsurance company. So we call another term for it, it's retrocessionaire. And what the reinsurer is doing is they're ceding a certain amount of risk to their reinsurers, which is the retro. Automatic reinsurance. So this is a contractual arrangement to participate in a defined portion of coverage across a product line. So for instance, term product, let's say you apply for $1 million, okay, on a term product. The underwriter reviews the case, we approve it standard. Now, depending on the treaty we have with reinsurance, we might just keep a portion of the 1 million at Sun Life. So, I mean, just maybe 20%. So what we'll do is we'll retain 20% of the 1 million, which is 200,000, and the remaining 800,000, we will automatically cede to other reinsurance depending on the treaty. So this is all done in the back scenes, but in the end, like I said, the contract is with Sun Life. But it's just a way for Sun Life to mitigate the risk to protect liability. So with retention I talked about earlier, the amount that we can retain for par is 25 million, but there are certain conditions where we would cut the retention by half. So when we have cases like aviation or professional athletes, or even high-risk occupation with, let's say, over $3.50 per thousand, these cases, we cut the retention by half. So if we can retain up to 25 million from age 21 to 70, but let's say the person is an aviator, we would cut the retention by half. So that would bring it down to 12.5 million. So remember, there's certain occupations and conditions where we have to cut the retention by half. Now, auto bind limits. Now, earlier I talked about retention. Auto bind limits, what it is, it's the maximum amount that the company can cede to the reinsurer without the reviewing of any requirements or reviewing their underwriting manual. So what this is, for instance, earlier I gave the example of our par retention is 25 billion. But our auto bind limit for par is actually 50 million. So what this means is, let's say you're applying for 40 million par. We can retain up to 25 million. But for the remaining 15 million, we can auto bind it with our reinsurer. What this means is, even it exceeds our retention, we can still provide an underwriting decision to you without sending it to reinsurer to review any of the requirements, which includes the application, paramedical, tele-review, APS, labs, etc. So this is what auto binding limit is about. I know it gets a little complicated, but try to understand as much as you can. Facultative insurance is the exact opposite of automatic insurance. Facultative is another word for it is called shopping. You'll hear this a lot. So it's a process of seeking out reinsurance support, generally on an impaired risk. So this is what happens. You submit a case to us. Let's say your client had a history of breast cancer. So Sun Life decided to rate $5 per thousand for, I don't know, let's say 5 years. But then we might get, the underwriter might look at the underwriting manuals from our reinsurance companies and say, oh, well, maybe this reinsurer can make a better offer. So what we do is we call something we call shop the case. So we send the case to reinsurers for a review and see if they can make a better offer with an improved rating. So we do this for impaired medical risk. Again, knowing that reinsurers can make a better offer. Or let's say if we postpone or decline a case, then there's no loss in sending it to reinsurers because either way, someone is declining or postponing. So if we can get an offer from a reinsurance, let's say a reinsurance is willing to make an offer at 200%, we would take the offer and then send it to you and say, well, congratulations, and we have reviewed the policy and we decided to accept this client with a 200% rating. So what you see from Sun Life is a communication sent out to you in 200%. But what you might not or may know is we probably shopped it to a reinsurance for a best offer. Now, there's certain risk with facultative insurance is, let's say if we make an offer to you at 200%. Now, as soon as we decide to shop the case, then the tentative offer we have is off the table. So what this means is if our assessment is 2%, but we think that we can get a better offer from reinsurance, but in the end we don't, let's say the best offer we got is 250%. What happens is we have to make an offer at 250% to you. So it's important, I'll stress this later on too, is if you have a case where you do get a rating and you're curious to know whether the underwriter shopped the case, I encourage you to reach out to maybe your RSD, your ISR, so Anson and Bernard first. If you get in touch with the underwriter, if you have one that is designated to you and you have a relationship with the underwriter, discuss with the underwriter to see if there's a possibility of getting a better offer with reinsurers, because sometimes there isn't. Sun Life, we are aggressive on certain medical conditions too. So if we think that we have made you the best offer, then it probably won't be best to send it to reinsurance. But these are, again, case by case. Jumbo limits. Jumbo limits is the maximum amount of which, once met, the coverage has to go to reinsurance for their participation and review. So our jumbo limit at Sun Life is from age 0 to 70 is 60 million. So jumbo limits are based on the maximum net amount at risk. So it's the NAR of life insurance pending and in force with Sun Life, and the total amount of the face amount, and the total amount of face amount of life insurance pending or in force with other insurance companies. So to simplify what that means is with jumbo limits, we look at the NAR of the pending in-force life insurance app at Sun Life, plus any face amount of life insurance pending or in force with all other companies to get to a jumbo limit. Now, if the jumbo limit exceeds 60 million, then we have to seek out capacity from our reinsurance. Now, if it's a joint last to die application where one life is uninsurable, then the jumbo limit only applies to the insurable life. Now, facultative access, it's a bit the same concept as fac insurance. It's just, I think this is more for financials when a case has been sent facultatively to reinsurers because it is over the company's auto binding limit or jumbo limits. So if it exceeds our automatic binding limit of 50 million for, let's say, for par and jumbo limits for 60 million, then we have to fac access or facultative access to the reinsurers. Just another terminology that we use in the underwriting world, but not so important for you. But just, I think in this particular slide, understand the difference between automatic binding limits, facultative reinsurance, and jumbo limits. So over the years, there have been 30 different reinsurers in the Canadian market. Most of them don't exist anymore. Currently, there are 7 reinsurers in the Canadian market. I think 2 years ago, there was 8, but then one of them quit the Canadian market. So now we're down to 7 reinsurers. And at Sun Life, we partner with 5 reinsurers for life insurance and 4 of them for critical illness. And just so you know that we actually partner with the five biggest reinsurers in Canada. Now, every insurance company works with different reinsurance company and have different treaties. So let's say you submitted an app through a competitor, Industrial Alliance or Canada Life, for instance. You get a rating and you know that, or it was declined or postponed, and you know that it was sent to a reinsurer for review. Now, they don't work with the same reinsurers as we do. So just because you get a rating from a competitor and it was shopped, it doesn't mean that we cannot make a better offer. So, because like I said, we work with the five biggest ones. So keep in mind. Every reinsurer has their own guidelines. I guess depending on their treaty, it depends. Every company has their own retention and capacity levels. So how do we maximize a reinsurance relationship? The two things you need to think about, I guess this is just a repeat of the two previous slides, is we have automatic reinsurance, facultative reinsurance. Automatic, it's the risk that's automatically ceded by Sun Life to the reinsurer in keeping with the terms of the conditions of the reinsurance agreement. So earlier I gave you that 1 million term case example. If you submit a 1 million term, let's say we retain 20% of it and we cede 80% to our reinsurers, no matter if it's standard or rated. That's something called automatic reinsurance that's done behind the scenes. Facultative insurance, we only do this for two reasons: impaired risk, so medical or non-medical, and financial. So financial, for instance, we run into scenarios where the applicant is trying to over-insure himself or herself, but there was a lack of financial justification. So, we might come into situations where Sun Life tried to obtain financial documents and we tried to justify financially, but we didn't get to the amount that the client desires. So in these cases, we can send them to reinsurance for a second opinion or for to see if they were willing to participate. And again, for financial risk, it could be because if it's surpassing the auto bind limits or if it's surpassing the jumbo limit, then we can send it to those. And impaired risk against medical, cancer cases, cardiac cases, actually all sorts of medical cases, we can send it to reinsurance for review. And then capacity, just to repeat, together with the five reinsurers that we work with at Sun Life, we can offer up to 300 million of net amount of risk, which is the NAR. So automatic insurance. Risk is automatically ceded by Sun Life to the reinsurer in keeping with the terms and conditions of the reinsurance agreement. I said this earlier, just to repeat and a reminder. Sun Life underwrites the risk and binds the reinsurer for each case without the reinsurer approving each policy being underwritten. So when you have five reinsurers at Sun Life, we have different treaties with each of them. So what this means is, if I go back to that $1 million case, Sun Life retains 20%. We might cede 10% to one of them, cede 15% to another, 5% to another. So this is all depending on the treaty. And treaty changes with time. So treaties get reviewed every couple of years between the reinsurer and the insurance company. And the terms are discussed. I mean, what's based on is mostly pricing, right? So pricing is determined on past claims experience, if there's any changes in the product itself, the features, if there's any changes, and also if our Sun Life's underwriting manual, if we've updated them more conservatively or more aggressively, that might change or affect the treaty terms. And like all insurance companies, we also get audited by a reinsurer to make sure that we are doing our own due diligence, we are following our guidelines and or reinsurance guidelines, and we're making sure that we're respecting the process of reinsurance. So automatic reinsurance, facultative insurance, jumbo limits, all etc. So all this contributes to reinsurance treaties. Now, to help illustrate what I've talked about earlier with automatic insurance, we have 5 reinsurance. Actually, the names are as you see on the screen. So we have SL stands for Sun Life, so that's just us. We have Gen Re, we have Munich, Partner Re, RGA, and Swiss. So they are the 5 largest reinsurance companies in Canada. So in this example, we have a Sun Life Term 10. Sun Life retains 10% of the risk, while 40% goes to company A, 30% B, 20% C, which adds up to 100%. Another example is Term 10. So direct company keeps the first 100,000 on every case, then cedes 40% to A, 40% to B, and C, the 3 treaty insurers, and keep 10% going forward. So this is just a different treaty term. For par policy, well, up to 25 million, Sun Life can fully retain. So this is what it means. The direct company, which is Sun Life, might keep it all. And after that, after 25 million, we get to the auto bind limits. What happens is when we get to amounts over 25 million, we would auto bind. And then what happens is we would cede 50% of the excess to reinsurance A, 25% to reinsurance B, 25% to insurance C, reinsurer C. So this is how automatic reinsurance works. It's a very simple process. Usually it's only one underwriter involved because why? Well, only Sun Life is, or only the insurance company is looking at the file. So there's only one underwriter underwriting the risk. It only involves one insurance company because we're not shopping the case, right? We're not shopping it facultatively. We're not asking reinsurance for a better offer. This is something that we are doing on our own. Usually applies to smaller face amounts because we're not running the capacity issues. We're not running to over retention issues, and also applies to younger ages, like I said, 21 to 70, and then cases that are at low underwriting risk. So we're looking at ratings below 200% because once you get over 200%, our retention decreases internally. So automatic binding limits, it's a negotiated maximum amount of risk in force and applied to insurer. An insurer can automatically bind, which is auto bind to the reinsurer. So I've talked about auto bind limits again, and I know I'm repeating, but I think it's good that I'm repeating because it's not something that I think anyone can understand after just listening to it once. So auto binding limits happens when we exceed the retention. So the industry auto bind limits depend on the company. Usually it's quite small. We're looking at about 3 to 5 million. That's common. Some companies might have to 10 million, some fewer than 20 million. At Sun Life, our auto bind limit for par is actually 50 million. So it's quite a big number for par. And then for term UL, it's 30 million. So if you look at someone who's from age 21 to 70, our limits are 50 million, and we're always thinking about the NAR, not the face amount. So be mindful of it. So it's the NAR. We retain up to 25 million because that's our retention, and then we can auto bind the next 25 million up to 50 million, giving us full autonomy of 50 million. So this is great because we can make decisions autonomously without going through the reinsurers. Whereas other companies, as you see, if a smaller insurance company, they have a smaller retention usually and smaller auto bind limit, which means that they have to send their cases to reinsurers for full review. And again, that could, take into more cycle time, more back and forth, more additional requirements, cover letters, etc. And if you're curious about ages under 20, so for ages 0 to 20, the auto bind limit is 20 million for par. So a lot less, but still quite a bit if it's 20 million. Now, FAC insurance, this is something that you're probably most interested in, is when the application, along with all the medicals and financials, are sent to reinsurer in order for the reinsurer to decide if they will reinsure any portion of the risk being offered. So this is what I talked about, shopping the case. Reinsurer underwrites the risk, ceding company selects the best offer from reinsurer. So let me go through the process with you, how this works. So let's say you submit a case to an underwriter or to Sun Life. Underwriter reviews the case, and the underwriter has assessed it at 200% for coronary artery disease and due to abnormal stress test. Now, the underwriter thinks that maybe we can get a better offer with the reinsurers, so let's shop the case, or let's send the case facultatively to reinsurance. Now, this is what we get back. Reinsurance A, we got an offer for 175%. Reinsurance B, 150%. C, 250%. D, declined. E, postponed, but willing to reconsider with the current echocardiogram. So we get all these back. Now, how does an underwriter look at this? The rule is the underwriter should always take the best offer and the quickest offer. So what this means is, what's the quickest offer here? I mean, if we go by chronologically order, the quickest is reinsurance A because they came back first. So it is a race. Reinsurers also work with a time limit. They have a deadline. So usually reinsurance, their cutoff is 24 to 48 hours. So it is quite demanding. I personally used to work at a reinsurance company before, and it's totally manageable, but you have to be quick and efficient in how you underwrite. You can't spend too much time on a file, because if you do, you start to lag, and then it slows you down and then you fall behind. Even if, as a reinsurer, you give the best offer, if you're not the quickest, you still lose the case. So in this case, reinsurance A came back first, but it's not the best offer. Who's the best offer? It's reinsurance B. So what happens here is the underwriter will end up taking the offer from reinsurance B at 150%. And in the end, what you get from an offer from Sun Life is actually 150%. So let's say change the scenario up a little bit. Let's say reinsurance A also comes back with 150%. Then in that case, we are going to go with reinsurance A because they are not only the best offer, but they're also the quickest. So we look at two things. Now, if reinsurance A comes back standard, then what happens here is we'll just cede the risk to reinsurance A and forget about the rest, because you can't beat a standard case. So reinsurance A, if it comes back standard, we'll just cede the risk fully to reinsurance A at standard rates, and then neglect all the reinsurance companies because it'd just be a waste of time. Like we don't need to wait for more. So with facultative reinsurance, you can see a lot more people involved. So I should make an edit to the slide. So if you have Sun Life, you got one underwriter. If you send it to 5 reinsurance companies, that's 5 more underwriters. So we have at least 6 underwriters looking at the same file, 6 insurance companies. And usually sometimes could be more than 7 underwriters, because if the underwriter at Sun Life or at the reinsurers have a co-signer and the underwriter's limit is only to a certain amount and the face amount exceeds his or her approval limit, they have to send it to co-signer for review. So sometimes you can even get more than 7 underwriters on a case. They might need to send it to a medical director for a second opinion for a review. So you can see with facultative insurance, you get a lot of people involved. Usually these cases apply to large face amounts because we run into retention problem, we run into capacity issues, and cases that are high risk factors. So they're highly rated in mortality risk, and or they're maybe postponed decline. So limits to automatic reinsurance capacity retention. Retention, you know this already, it's the amount that Sun Life is willing to retain on a life or per product basis. So for par, it's 25 million on a single life, 30 million on a joint loss to die basis. Retention capacity, auto binding limits, I talked about it earlier. Factors include product, mortality, age, special risk. All this affects the retention capacity auto binding limits. So if you run into high risk occupation, like I said, aviation, even entertainers, foreign travel, hazardous sports, these can cut retention by half. For Sun Life retention based on NAR, again, it's always the NAR we're talking about. And it's reduced at younger age and older ages. So if you have a child who is from age 0 to 2, our retention limit is actually quite low. It's only 2 million. So then we have to explore the auto bind limits, or even back access, depending, because if you have a child that's, let's say, 1-year-old and you want to purchase the SPA, the PAR accumulator, I've seen cases where it's only a couple of million in face amount, but the NAR can go up to over 20 million. So these cases, we would have to send to reinsurance for review. But again, so we look at retention, we're looking at the NAR. Response time can vary from 4 weeks versus 2 weeks. So this is, again, we're talking about facultative reinsurance. You can see how the flow of the file. You always start with the underwriter, and then the underwriter can send their file to a medical or their cosigner if it surpasses their approval limits. So the cosigner has to review the case, and then if the cosigner is not comfortable with the risk, he or she might need to send it to the medical director for a second review. So, and then if they decide to, let's say, postpone or make a highly rated offer, then we have to explore the possibility of getting a better offer from reinsurance. And then once that sends to reinsurance, it comes back, goes back to the cosigner, goes back to the underwriter, and then if we do make an offer, it goes to the case manager, issue of delivery. So there's a lot of people involved in a case. And then not only that, people can be on vacation, sick leave. Sometimes we call it the high season, year-end, tax season, usually high season. So what happens is that just increases cycle time. Now, like I said earlier, reinsurance, they have to beat each other when it comes to time service. So reinsurers try to give the best offer in the least amount of time. So they're always striving for the turnaround 24-hour to 48-hour service. And they're usually pretty good at it. What happens is, even if we send it to the reinsurer and they get it back to us 2 days later, the underwriter has his or her own workflow. So that might not even be looked at until a later date. So when we get to the reinsurance, sometimes it does add in, unfortunately, it does add into more cycle time because of just managing workflow, vacation, sick leave, underwriter covering off an underwriter's workload. So a lot of factors that can contribute to service delays. Now, some of the large complex cases can take more than 2 business days because there is more people that need to review, right? So you have the medical director, you have the co-signers, sometimes reinsurance. So there's a lot of factors that can contribute to this. But just so you know, if it's not a large case, or you're looking just a medical impairment risk, you should be getting back an answer from reinsurance within a week. All right. And if you haven't, then I suggest you send in a follow-up to your underwriter because they might have a response back to the reinsurance already. They just haven't had the time to look at it yet. So bear that in mind. So other tips, this is where I kind of want to talk about multi-apping. With multi-apping, I like to say if it's not a large case, for instance, let's say it's a cancer case, you want to get the best offer for your client and you choose the multi-app. That's fine, because those cases we're not running into jumbo limits, we're not running into capacity concerns. So we don't have to send to the reinsurance to reserve capacity. We're just trying to get the best offer for the cancer case. So what happens is usually you have to choose a lead company. That lead company will order all the medicals. So paramedical, labs, and APS. And then by then, once it's been ordered, reviewed, they'll share it with the other carriers that you chose to multi-app with. So for instance, if you decide to multi-app with 3 companies, Sun Life, Equitable Life, Industrial Lines, and you choose Sun Life as a lead company, then we'll order all the requirements first. And then once we get the med share request from EQ and IA, then we'll share the meds to them. Now, you have to be mindful. Some companies don't share until they've made an offer. So it's wise, and you have to be prudent to when you're choosing which lead company you want for your case. So if, let's say, your top choice is a Desjardins, right, for instance, or actually you're in BC, so maybe something more you're more familiar with. So let's say Canada Life. You choose Canada Life, then you have to be mindful that sometimes Canada Life may or may not share their medicals with us until they have the decision. So even if Sun Life, if your top choice is Sun Life, you would have to wait until we get the meds before from Canada Life before we can give you an offer. So just to be careful when you do multi-app and who you choose as a lead company, because that can also, you might not be able to get a decision at the same time. Now, if it's a large case, then it's very different. I don't recommend multi-apping for large case, and the reason is because we run into capacity issues and jumbo limits. When you multi-app a large case to multiple companies, the lead company would have to first reserve capacity from reinsurance. And that insurance, that lead company, once they have the capacity reserved, the other second or third insurance company, it blocks us from reinsurance from getting capacity, which means that even if the second or third company makes you a better offer, we can't give it to you because we don't have the capacity. So what I recommend you to do is when you have a large case, I suggest you send them one by one. What this means is you send it to company A. They do their full underwriting, they get their capacity from their reinsurers, they give you an offer. If you're not happy with the offer or you think you can do better, then submit the app to another company. And then that company, if they do manage to give you a better offer, well, you can just not proceed with the company A and go with company B, and you eliminate the capacity reserve problems. So small case, you can multi-app. Large case, I suggest you don't multi-app. Do reinsurers provide the same offer? No, they never provide the same offer. As you probably remember the example earlier, some of them rated 200%, some 150, some decline, some postpone. It's all over the map. So this is also the danger of multi-apping is if you multi-app and you have insurance companies sending the case to reinsurers for review, reinsurance company, they might come back with different information of extra requirements. Some want this. Some want additional labs, some want additional APS, some want additional financial document. So you do run into some frustration and communication problems with the danger of multi-apping. So I think you have to understand your case first before choosing the right path, multi-app versus multi-app. How much negotiations done with the reinsurer? This is all between the underwriter at Sun Life and the reinsurance. So you don't have to get involved with communication with the insurance. It's all between insurance companies and reinsurers. And the advisor can't contact reinsurer. This is something that's being filtered by us. So any communications will go to us first or other insurance carriers and then gets filtered to the reinsurers. Reinsurers are involved in claims and recessions, but ultimately the contract is with the insurer and only the insurer is responsible for paying or denying the claim. So I think I'm just going to skip some slides because I'm getting low on time. I do want to get to the financial updates. So I'll jump this slide. So I want to, since I was talking about multi-apping and knowing your client, and well, in this case, it's the art of negotiation. I want to use a case study to show you how this works. So we have a case here with a joint last to die par, male 73, female 71. They're looking for 8 million. So the clients already have 7.5 million in force with Sun Life. The Sun Life underwriter assessed it at medically borderline standard, but we're running into capacity and retention problem. Once you get to age 71 to 80, the retention at Sun Life is only 10 million. So it went from 25 million from age 21 to 70 to 10 million from the age group of 71 to 80. So with 10 million, well, the clients already occupied 7.5 million in force. So what we're left with at Sun Life is 2.5 million capacity. But now we're still short. We still need 5.5 million of extra capacity because they're applying for 8 million. So in this case, we have to send, in view of total line, we have to send the file to the reinsurance. And this is what we get. Reinsurance A has a capacity of 5 million. They offered at 175% for male and female, not the best, because we have better. Company B, Reinsurance B, we got a standard for male, but 150% for female. Reinsurance C set 150%, but they want an APS, female standard. So we're running a bit of an issue here. We do have some good offers, but we think we can do better. So what we did here, the underwriter made a call, try to negotiate with the reinsurance, and then at the end of the call, we did manage to get standard for the female life for reinsurance C, and then we got a 150% from reinsurance C for the male life without the APS. Now, that's already better, but there's also a problem because company B only has a 4 million capacity, but we need 5.5 million capacity. So the negotiation is not over yet because we have to get all of it from one reinsurance. So we made another call, and this time we managed to get reinsurance B to give an extra 1.5 million capacity on this joint case, and then company C also got a standard. But in this case, what we did was it was brilliant because what we did was we managed to get the remaining capacity from reinsurance B because they gave us that 5.5 million capacity. So they're 4 million plus the 1.5 million, which gives us 5.5. So this is how the negotiation works. Case study number 2. Male, age 22, flies a private plane, has quite a bit of solo flying experience, 300 hours, no insurance in force. He's looking for 20 million term insurance, no other in force elsewhere. 2 questions for you. What is Sun Life's maximum retention? Can we auto-bind the risk to reinsurers? So if you remember, with high-risk occupation, actually, even for all aviation activities, retention is cut by half. So if you remember, the retention from ages 21 to 70 is 25 million. So what's our maximum retention? We're cutting it by half. So our maximum retention is 12.5 million for this case. And can we auto-bind to reinsurers? No, because this is a special risk. So special risk, we cannot auto-bind. This means we have to shop the case to reinsurers, which means they have to look at the file entirely, including the medicals, the APS, and if there is one, and the application. Last case study, we have a business owner, age 54. She has 15 million in force, looking for extra 25 million par at Sun Life, and the 25 million par has a 31.6 net amount at risk. So that's the NAR. Application also pending is 25 million with Canada Life and 25 million at Manulife. One to place. The question is, can we automatically cede the risk to reinsurers? Now, the answer is no, because now we're looking at jumbo limit, right? Our jumbo limit is 60 million. Even though it's single policy place, we have to consider all the pending apps that are ongoing. So she has 15 million already. And then we have to add 25 million each from Canada Life and Manulife, so that's another 50 million. So adding the in-force of 15, so we had 65 million, plus the pending 31.6 million at Sun Life, which brings us to 96.6 million. So again, when it's Sun Life, we're looking at NAR. With the policies outside of Sun Life, we're looking at face amounts. So we got up to a jumbo limit of 96.6 million, which means we have to facultatively send fac access to our reinsurers. So we cannot automatically cede. We have to facultatively cede the risk to reinsurers. Now that concludes the Reinsurance 101 section. I just have 2 slides to show you for our updates with financial guidelines that's been effective as of early April this year. So look at all the new things we've come up with. So there has been some changes added to income replacement from the age band from 16 to 30. We used to allow a 30 times multiplier for income replacement at that age group, but now we're increasing to 35 for ages 16 to 30. And then for ages 70 to 75, usually that age group has no income replacement. It's really rare that we see that there's income replacement need from age 70 to 75. So the old guideline, we limited to 100,000, but now we're allowing up to 5 times their annual earned income. Non-income earning spouse, we've increased from 500,000 to $1 million. It can actually go up to more than $1 million, but case by case. I think it can go up to 5 million, but it depends on the breadwinner. So how much he or she has in terms of face amounts and or existing insurance coverage. Unemployed, we went from 250K to 500K, and that's the maximum. Children, we're talking about ages 18 or less, or dependents over age 18. So especially Asian market, you see some cases with dependents. They're still living with their parents. In those cases, we can still put them in the same category as minor coverage, so child under age 18. So before, we allow pretty much up to 25K without asking additional questions. Now we're increasing that limit to $500,000. So if you're submitting an application for a child under 18 or even a dependent over age 18 for $500,000, then we don't care whether or not the parents have insurance or not. It's pretty much automatic approval up to 5 million, up to $500,000 for child's coverage. It's only when we get to over 500,000, then we look into the parents' coverage. Now, if you remember our old guidelines, if the face amount exceeds 1 million, then we expect both parents to double the child's coverage. Now we're not expecting both parents. We're only expecting one parent to have doubled coverage. So if you're applying for $1 million for your child, for your client's child, then the policy owner, either the mother or the father, needs to have at least double the amount of coverage. So at least 2 million of coverage, personally owned. And then we look at the family Canadian net worth. So that has also changed a little bit. University students, apprenticeships graduates, we've increased the maximum coverage from 1.5 million to 2 million. That's very self-explanatory. If you want over 2 million for a university student, that's case by case. I think we don't have to look at what they're studying. If it's a doctor, a lawyer, or engineer, we can probably go more than 2 million because we expect them to make a generous income once they graduate. Bankruptcy, we've increased from 250K to 500K. Now, lastly, it's the change in terms of estate tax need. So we're still pretty much using the same formula for estate tax need to calculate future capital gains tax. We are using what we're used to using is assuming a growth rate of 6% and multiplying it for 20 years, and then applying the provincial and federal tax bracket to get to the future capital tax gain. Now, what has changed in the new guidelines is the years of estate growth. So once you get past, well, up to age 60, we're using 20 years. But once you get to age 61 and over, it goes into a decreasing curve. So up to age 80. So if you got someone who's 65 years old, then we're only going it out for 15 years. 70 years, we're going for 10 years. If the person's already 75, then we go for 5 years. Once you get to 80, we're not growing it anymore because, I mean, I think at the time we probably don't. It's hard to at that age the mortality was actually pretty high, so we're not going to grow it out to further years. And then if it's joint loss and die policy, then we're using the joint age per the illustration. So this concludes our presentation. Any questions?